Hello, everyone. Hopefully you can see me okay and hear me. About ready to kick off the webinar today on cash balance plans, what they are, how they work. We're going to give it another minute or so, 30 seconds or so. I know there's a few other people looking to log on here shortly before we kick things off. Couple things I did want to note. On the right-hand side, there is a chat section you'll see. You're welcome to type in any questions. Feel free to type in questions as you go. As they come up, I'll answer them as I can. There will be a separate section in the back for some Q&As. Also, if you want to take a closer look at the handouts here or the slides that I've got, there's a handout section up above to the right. You could just download it right there, and that'll give you some good information. We're going to be doing these webinars through the fall. Good way for a lot of people to get some sort of an intro understanding about these plans and how they work. So hopefully they help you out. If you want to sign up for one later in the year, you're more than welcome to. I know these plans can be a little bit complex. So we're going to dive in just a minute here. So just a second. All right, let's get this thing going. So today we're talking about cash balance plans, what they are, how do they work. It's a little bit of an intro sort of webinar to just talk a little bit about some of the basics. We're going to go about probably 20, 25 minutes or so. We've also got a special topic that we're going to talk about. Each one we do, we like to cover a little special topic. Today it's going to be interest crediting rates. We're going to talk a little bit about the various interest crediting rates that you can use, why you'd want to use them, what rates to select, how they impact your plan and your investments. So we're going to kind of dive into that a little bit today in our special topics. So let's just get going here. First slide, we'll talk a little bit about the overview. We'll talk a little bit about what we are, what we do, who we are. I'll tell you a little bit about myself. We're also going to talk about what a cash balance plan actually is. We'll try to understand the pros and the cons of the plans. Whenever I'm talking to a prospective client, I always want to discuss the pros and the cons of the plans. That is the most critical thing to make sure I go over who a good candidate is. These plans are great in the right fit, but there are situations where they're not the best fit. Also want to take a look at some of the strategies that we use when we set a plan up. Again, our special topic today, we're going to talk a little about interest crediting rates. And then lastly, I'll open up for the Q&A. Again, I've got the questions that have been emailed over to me, but certainly feel free to submit them in the chat and I'll try to address them as we go. So the first thing about myself, I am a CPA by trade. Been a CPA for 30 some odd years. Been structuring these plans with my clients for about 10 to 15 years. And that's pretty much all we do now. I also do some additional retirement structuring, certain comprehensive tax planning, entity structuring. We get involved from a variety of different types of planning things from time to time. But primarily these days, I just help kind of structure these plans and do a lot on the front end when it comes to setup and design. About Emparion, we are a third-party administrator. And again, we do retirement structuring. This is going to include cash balance plans, other types of defined benefit plan structures. We handle all the administration and compliance work. We are not financial advisors, and we do not do tax returns. Even though I'm a CPA and have done tens of thousands of tax returns, I don't do them anymore. If you catch me on the phone and you have some tax questions, I'll usually do a pretty good job of trying to answer some of those, or at least give you some insight. And we also spend a lot of time talking to CPAs as well. But our goals is always to educate clients and CPAs on these plans. Probably no surprise that probably 90% of clients do not understand these plans and how they work. Or should I say clients? That's kind of true with clients, of course, but when it comes to CPAs and financial advisors, most of them know these plans exist, but they really don't understand the ins and outs. Also, our goal is, of course, to help lower tax bills and to grow your retirement accounts. The number one reason people do these plans is to lower their taxes. So, that's what we do at Emparion. What is a cash balance plan? So a cash balance plan is an IRS approved qualified plan. And what we mean by qualified is it's qualified for full tax deferral. You get a tax deduction when you pull the money out. You're taxed at retirement when you get a tax deduction when you put the money in. You get you're taxed on it as income when you pull it out. Presumably that's much later in life as it grows tax deferred and you're at a much lower tax bracket. It is a type of a defined benefit plan. It expresses or it promises a specific benefit at retirement. And because that amount is such a large amount at retirement, you could get up to $3 million because that contribution is so large to the plan, or the benefit at the end of the day is so large, you can get much larger contributions. Our average contribution, we ran a study and it was $100,000, about $150,000 roughly a year is the average contribution to the plan, but typically over $100,000 with full tax deferrals. We've got situations where we're able to get $500,000 plus into a plan. So plans work out great for a lot of folks. What is the difference, our next slide, between a defined benefit plan and a defined contribution plan? Many people are well aware of defined contribution plans like 401k plans, SEPs, plans of that nature. A 401k plan establishes the limits up front. So you've got a specific limit, a deferral and a profit sharing. Once you contribute to that amount, it doesn't matter what happens with the account balance, whether it goes up or down. The limit is established up front, okay? Defined benefit plan works a little bit in reverse. We can get in up to $3 million into a plan by retirement. And so because we have such a large amount, we can make these larger, $100,000, $200,000 a year contributions to build towards that actual $3 million account balance. A lot of people are not going to qualify for $3 million, but regardless, they're going to be able to get a much larger balance. So it allows for those much larger contributions. But a key thing to remember is that the investment balance, and this is contrary to a 401k plan, the investment balance itself is very relevant because once you get to that $3 million number, you can't contribute anything more into the plan. So every dollar you put in and all the investment returns is that much, makes contributions to the plan that much lower. So your investment account returns are very important. That's why we'll talk a little bit about these interest crediting rates here in a little bit, okay? There are specific rules when you combine plans. As a general rule, you can combine these plans with 401ks. Most of our plans are combined with 401k plans. You cannot combine them with simples. Most SEPs do not allow them. SEPs do not work very well, but 401ks, we structure them with 401k plans all the time, and that's a great structure for most people. Why do people set up these plans? Number one reason, tax deferral. Again, if you're in a high taxing state, especially if you're in, California, New York, New Jersey, some of these high taxing states, you can get a large tax deduction when you contribute the money. When I mean large tax deductions, we talked before, up to $300,000 annually for a lot of people. Might not be the same situation for everybody. Everybody's unique, but very large contributions. It's also a great way for owners to be able to catch up on their retirement. And they can be rolled over into an IRA. Even though these plans are set up as permanent plans with indefinite lives, they can be rolled over rather easily into an IRA. So, that's usually the exit strategy. A lot of people will keep these plans open for 5-10 years and then roll them over into an IRA. Our average lifespan of a plan is about 7 years. Also, you can contribute up to the date the tax return is filed, including extensions, with the latest date being September 15th. Okay. And they're also not just for large businesses. A lot of people think that these plans, being more traditional pensions, are best suited for large companies, the Googles, the General Motors, those types of companies. of the world. That's certainly true, but they are available for a lot of small employers. In fact, single member S corps, sole proprietors, we do them for those types of people all the time. Let's talk a little bit about the pros and cons. As we've discussed, one of the big benefits is the ability to contribute the much larger amounts, certainly much larger that you can get in for an average 401k. You can also combine them with the 401k, pending the various rules that are in place. You also can roll these plans over into an IRA or even a 401k once you terminate them. Okay, so they're very effective to roll over. And lastly, you do have some funding flexibility. A lot of people think that they're locked into these, 150 grand a year or whatever the contribution is going to be. That's not the case. Generally speaking, these are going to be determined based on your W-2s, your business income if you're a sole proprietor. So, needless to say, there is some funding flexibility because we do give you a range. We give you a minimum range, a maximum range, and then we also have a target for you. We typically recommend people stick close to the target. Now, the cons of the plans, they are more expensive to maintain. We'll typically set a plan up for $1,200, $1,300, but your actuarial review is going to cost you about $2,100 a year. So they will cost $2,000 to $2,500. You've got a very large plan. It could be $4, $5, $6 grand a year, but in most situations, that's not the case. But certainly they are more expensive. That's why they only make sense if you want to get, 6 figures of contributions in. They are permanent in nature. Don't have to have them forever, but you want to have them at least a few years. Our average client has them 7 years. They're also more complex to explain to clients, more complex to administer, and more complex to understand. They're not as easy as a simple 401k plan. And the contributions themselves are mandatory. Again, you're not fixed at this amount. You do have a funding range, a minimum, a target, and a maximum. However, you are kind of dialed into a funding range. If you have an amount, if you need to contribute below that range, or if you want to contribute above that range, there's going to be some issues, potentially some excise penalties. So if you think that's going to be an issue, certainly reach out to us. But you certainly want to make sure you're have the financial ability to contribute to these plans for a few years. Who are the best candidates? Companies with consistent profits. Usually companies that make, $300,000, $400,000, $500,000 a year plus, or smaller companies where maybe they don't have the earnings, but they want to be generous to their employees, kind of treat it like an employee bonus. Professional service companies are great. A lot of our clients are doctors, physicians, lawyers, CPAs, etc. Also, owners looking to catch up on retirement savings. Obviously, if you're a little bit behind, these are great opportunities. If you're in your late 40s, 50s, to be able to catch up on these plans. Also, great for owners looking to maximize tax deductions. Again, if your income is very high or you're in a high taxing state, they're great plans for you. Also, companies looking to improve morale and employee retention. If your motivation is to help out your employees, a lot of employees definitely appreciate these things. They're in a tax deferred account. They're portable. They can be rolled over into IRAs. They actually make a lot of sense for a lot of folks. Okay. We're going to take a look right now at a few funding examples. People always ask, how are these plans done? These are solo plan examples. We don't have any here for a group plan. Certainly, you could reach out to us if you've got any questions. But first example, 35-year-old IT consultant, W-2 of 200 grand, business profit of 150. They can do a deferral. Under 50 can do a deferral of 20,500. Profit sharing is capped at 6% of compensation, which is different from the traditional 25%. And in this example, cash balance plan contribution of 130, which at a 40% tax bracket gives you $52,000 savings. Okay. For 58-year-old, the next example, remember that these plans are income and age based. So someone contributing, if the 58-year-old has a $200,000 W-2, they could get a deferral of $27,000 in, as you can see. Profit sharing is still 6% of the $200,000. And then the cash balance plan contribution in this example is $212,000, which gets them a total contribution of just over $250,000, or tax savings at 40% rate of about 100 grand. So pretty sizable savings there. Lastly, we've got an attorney, a 65-year-old attorney that's paid themselves $305,000 at the max and has a business profit of $2 million. In fact, we deal with a lot of attorneys that have structured settlements and a variety of certain types of settlements and things like that, where they can get very, very large profits for 1 year. Maybe they're going to make $2 million this year, but next year they're only going to make $300,000, $400,000. We can structure a plan so they can get a very large amount. In this example, the deferral is $57,000, which is, $27,000, which is the same, which is the same as a 58-year-old. For anybody over 50, they can get in the 27. The profit sharing is 6% of the 305, or $18,000. And you can see the cash balance contribution is $502,000. So it's a very sizable amount. And what we do is we can use prior service and a couple other things in order to get that contribution much higher. So, this client in this situation is able to get $547,000 into the plan in year one with a tax savings of about $219,000 based on a tax rate of 40%. So pretty sizable savings for that person. Couple strategies that we can use to get more into a plan or to allow additional flexibility. You can include a spouse, consider paying yourself a higher wage. Again, these are age and income driven. So the higher your wage, the better off you are. We can also exclude 60% of employees. We have to provide a meaningful benefit to employees, which is typically only 2 to 5%, give or take. Although you might have to get a little bit more in to reach a couple other tests. It's called Gateway and a couple other things. You could combine with a 401k and a profit sharing plan, like we discussed. Some clients have part-time employees or employees that work under the age of 21. They're not qualified for the plan. That works out very well for them. You can also consider contract employees. Any sort of contractors would not fall into the plan. We also can use 3-year vesting. What vesting means is you can get a contribution under the plan, but you're not allowed ownership of that vesting amount until 3 years. You can also do life insurance in the plan. Doesn't work out well for most people, but for some people, if they're looking to get larger contributions, or if life insurance is very expensive for them, that can make a lot of sense. Number 10, Section 199, that's QBID. They do allow for a QBID deduction, which can give you another 20% off your business income. And number 11 is, you can determine if overfunding is an option. There are situations where you can overfund or fund at the maximum. That will tend to reduce future contributions, but can be a great option if you've had a situation, you have a very high income year and whatnot, okay? Deadlines to consider. The deadline to set up the plan is the date the tax return is filed, including extensions. So you do have plenty of time. We do tell people that you want to be very concerned about the deadline, though. Even though you can set these plans up next year for 2022, you have to establish 401k limits. 401k's got to be established by the end of the year. You don't want to overfund profit sharing. You want to get your W-2s taken care of. Variety of issues like that. So we tell most people to try to make a decision by November 1st as we go into the end of the year. You also do have the contribution deadline, like we discussed, is up to the date the tax return is filed. So we have a variety of other situations where you've got some flexibility as far as when you can fund the plans. Special topic. So like I said earlier, we try to do a special topic in each one of these to just talk a little bit about. We do have some clients that want to attend multiple of these just to kind of hear the information over and over again. As far as interest crediting rates are concerned, these plans are based on have an implied interest crediting rate, usually around 5%. There are certain rates that the IRS approves. So you can generally go in that kind of 3 to 6% range. You also can choose some other rates like, T-bills and other types of rates. But generally speaking, the rates are going to be, variable rates in that sort of 2 to 5% range. Most administrators like ourselves will typically do a 5% interest crediting rate. But realistically, I think people get carried away on what it means, whether it's a 4% rate or a fixed percent. The actual overall interest crediting rate isn't going to tie into your contributions that much. But what ties into it a lot is your investments. So if you've got an interest crediting rate of 5%, you generally want to mimic the 5% investment returns. Nowadays, you can get a CD for 4%, for example. Because you can get a CD for 4%, you know, it might be a good fit to do, say, 80% in a CD, you know, 20% in a stock account, in stocks, something like that, or bonds. And that way you can kind of get a blended amount. You're never going to get exactly 5%, but you're going to get 0 to 10%, you know, something in that range. So, you know, interest crediting rate's an important thing to consider. I wouldn't get too caught up on whether using fixed or variable, but I would make sure you keep your investments conservative. You want your investments to generally mirror your interest crediting rate to the best of your ability. Okay. Lastly, at Emparion, we have a turnkey solution. I mean, we do free plan illustrations, free strategy reviews. We do all the compliance with the IRS, Department of Labor, and our actuary reviews and signs off on all plans. So we do everything that we can to try to structure these plans and do all the compliance for you. We're going to take a look at some questions here in a second. We'll kind of dive into it, but certainly feel free to email with me with any questions. If you want to type your question into the chat, you certainly can. I've actually received a couple other questions here, so I'm going to go through them right now, and then we'll conclude it at the very end. You're going to be directed to our Contact Us page. If you like, you're certainly welcome to sign up for an actual call with us or schedule something with us. We'd be glad to run a custom illustration for you and your business. A couple questions I got. Let's see. Can a sole proprietor open a plan? Yes, absolutely. Sole proprietors can open a plan. You don't have to have a corporation, C or S corporation. You can be a sole proprietor. The calculation is a little bit more complex, but if it's just yourself in the business and you've got a small business with some, well, small business meaning it's just yourself, but you've got a decent amount of income, reach out to us. We could certainly run an illustration for you. How long does it take to set up a plan? Good question. We tend to set up plans in about a week. Our general plan is going to take us about 5 business days to set up. Obviously, every situation is a little unique. As we get into the end of the year, it gets a little bit busier, might be a week and a half. We can also do rush jobs. That'll be a little bit quicker too. So, you know, that's kind of the 1 week is about average. Also, if you do an onboarding call with us at the end, we can help you get your investment accounts set up. Last question I got is, what can I invest in? We talked a little bit about that when we were talking about interest crediting rates, but you can invest in almost anything, but you do want to keep your investments, again, rather conservative. To offset that conservative nature of these investments, you can make sure your 401k plans are invested much more aggressively. You can get those in full stocks accounts, you know, NASDAQ indexes, a variety of things, but try and keep this as conservative as possible. And again, this is a great environment to get a rather risk-free rate on a 401k. So that can make a lot of sense for a lot of folks. That's it. Any other questions or anything? Let me see if I've got anything else. Again, this class was meant to be, or this webinar was meant to be just kind of a high-level overview. You've got the handouts on the right-hand side. Feel free to download those if you want to look through. Again, reach out, sign up for a plan with us. We can run a free illustration for you and see if it's a great fit for your business. If you're interested, certainly sign up for another one of these. We do a lot of them through the end of the year. And hopefully you learned something, and hopefully we can touch base soon enough and help you set up a plan. Okay. Looks like that's it. I don't see any other questions coming in. So that's it for today. And we hope to talk to you soon enough. Have a great day.